At first, it sounded like a dramatic headline, but within hours, the story began to take shape across major Western newsrooms. According to Reuters, U.S. officials confirmed a series of coordinated strikes targeting Iranian naval assets following escalating tensions in the Strait of Hormuz. Shortly after, the Associated Press reported that American forces had struck multiple maritime targets in response to what Washington described as destabilizing actions threatening international shipping. This was not an isolated skirmish. It unfolded at one of the most strategically sensitive waterways in the world. The Strait of Hormuz is not merely a regional corridor. It is the artery through which roughly 20% of the world's oil supply flows daily. U.S. Energy Information Administration data consistently highlights its significance. Millions of barrels of crude oil and large volumes of liquefied natural gas pass through this narrow channel every single day. Any disruption, even symbolic, sends immediate shockwaves through energy markets. Bloomberg noted that traders reacted within minutes to reports of renewed tension in the Gulf. Oil futures spiked as risk premiums widened, and shipping insurers began reassessing exposure in the region. CNBC later reported that defense stocks in the United States rose in early trading, reflecting investor expectations of prolonged instability. But what triggered this moment? In the days leading up to the reported strikes, Iranian authorities had signaled potential restrictions on maritime movement through the strait. While Tehran framed these signals as defensive posturing amid regional tensions, Western officials interpreted them as an attempt to leverage geographic control for strategic gain. According to coverage from the Wall Street Journal, U.S. defense planners had been monitoring Iranian naval deployments and missile capabilities near key choke points for weeks. From Washington's perspective, freedom of navigation in Hormuz is non-negotiable. Successive U.S. administrations, regardless of party, have treated maritime security in the Gulf as a core strategic interest. The Fifth Fleet, headquartered in Bahrain, exists precisely to ensure that commercial traffic can move without coercion or disruption. That context matters. When U.S. officials described their response as measured but decisive, it reflected a broader doctrine often referred to by defense analysts as escalation dominance. In simple terms, it means maintaining the ability to respond at every level of confrontation with overwhelming capability. Defense news has repeatedly highlighted the technological gap between U.S. naval forces and Iran's asymmetric maritime strategy, which relies heavily on fast attack craft mines and drone systems. At the same time, Iranian state media outlets such as IRNA portrayed the events differently. Iranian officials emphasized sovereignty concerns and accused the United States of militarizing the Gulf. However, independent satellite imagery reviewed by Western analysts suggested that military activity had intensified near sensitive maritime routes prior to the exchange. The divergence in narratives is striking, but it underscores a familiar pattern in modern conflicts: information warfare unfolding alongside physical confrontation. For U.S. allies in the region, particularly Saudi Arabia and the United Arab Emirates, the stakes are immediate. Al Arabiya reported that Gulf states were closely coordinating with American defense officials, seeking reassurances that commercial routes would remain open. The National, based in the UAE, emphasized that regional economies remain deeply tied to uninterrupted maritime exports. In short, what began as a localized escalation rapidly evolved into a strategic confrontation with global implications. This is not merely about ships or missiles. It is about deterrence, credibility, energy security, and the balance of power in one of the world's most volatile theaters. The opening phase of this crisis suggests that Washington intends to send a clear message: threats to the Strait of Hormuz will be met with swift and substantial response. The deeper question, however, is whether this episode represents a temporary flare-up or the beginning of a more sustained period of instability in the Gulf. That is where the strategic analysis must now turn. If you want to understand why this moment feels bigger than a routine naval exchange, you have to zoom in on a narrow strip of water barely 21 miles wide at its tightest point. The Strait of Hormuz. On a map, it looks almost insignificant. A thin blue line between Iran and Oman. But in reality, it is one of the most powerful pressure points in the global economy. According to the U.S. Energy Information Administration, roughly 1 out of every 5 barrels of oil consumed on the planet passes through this corridor. That is not just a statistic. That is leverage. Think about that for a moment. Every morning, tankers loaded with crude from Saudi Arabia, the United Arab Emirates, Kuwait, Iraq, and even Iran itself move through this passage. Qatar's liquefied natural gas shipments, critical for Asian and European markets, depend on it. When Bloomberg tracks oil flows, Hormuz consistently shows up as the single most important maritime choke point on Earth. So when tension rises here, it is never local. It is global. Reuters energy analysts have repeatedly warned that even symbolic threats to shipping in Hormuz can trigger immediate price reactions. Not because ships have stopped moving, but because markets fear what might happen next. Oil does not have to disappear for prices to surge. Fear alone can move billions of dollars in seconds. Now the question becomes sharper: why now? This is not the first time Iran has hinted at restricting maritime access. Tehran has invoked Hormuz as strategic leverage for decades. But timing is everything. The region is already tense. Proxy conflicts simmer. Sanctions remain in place. Diplomatic channels are strained. From Washington's perspective, any move that appears to challenge freedom of navigation is seen as a test. And history shows that when maritime choke points are tested, the response tends to be firm. The Fifth Fleet, headquartered in Bahrain, exists precisely because of this geography. American naval planners have spent decades modeling scenarios around Hormuz. Mines, fast attack boats, anti-ship missiles, drones. Every variable has been studied. Defense News has frequently pointed out that while Iran relies heavily on asymmetric tactics, the United States maintains overwhelming conventional superiority in open maritime conflict. But here is the deeper layer. Hormuz is not just about oil, it is about credibility. If a state can threaten a corridor through which 20% of global oil flows without consequence, it changes the balance of deterrence worldwide. Allies begin to question reliability. Adversaries begin to test limits. That is why regional partners are watching closely. Al Arabiya reported that Gulf states have been in constant consultation with U.S. defense officials. The National in the UAE emphasized how deeply regional economies depend on uninterrupted maritime exports. For them, this is not abstract geopolitics. It is daily revenue stability and survival. And what about Iran? Iran understands this geography as well as anyone. It knows that closing Hormuz outright would be economically devastating, including for itself. Nearly all of its own oil exports pass through the same waterway. That is why many analysts, including those cited by the Wall Street Journal, argue that Tehran's strategy often revolves around signaling rather than sustained closure. Pressure, not permanent blockade. But signaling is dangerous, because once military assets begin maneuvering near choke points, misunderstandings multiply. A drone here, a warning shot there. Insurance premiums spike, tankers hesitate, and suddenly a narrow strip of water becomes the center of global anxiety. This is why the current escalation feels so consequential. It is not simply about who fired first or which vessel was struck. It is about whether the balance of power in one of the world's most vital arteries is shifting. Hormuz magnifies everything. A minor incident elsewhere might pass quietly. Here it echoes through trading floors in New York, refineries in Asia, and fuel pumps across America. So when Washington signals that it will not tolerate threats to navigation, it is not only responding to one action. It is defending a principle that underpins the modern global economy. The real question now is not whether Hormuz matters. It is how far each side is willing to go before the cost becomes too high. The moment tension rises in the Strait of Hormuz, the reaction does not stay in the Gulf. It travels. It moves through oil terminals in Saudi Arabia, across trading desks in London, into futures contracts in New York, and eventually quietly but relentlessly into gas stations across America. This is where geopolitics becomes personal. Within hours of reports of renewed instability in Hormuz, Bloomberg tracked a sharp uptick in oil futures. Traders were not waiting for full confirmation of physical disruption. They were pricing risk. Because when roughly 20% of global oil flows through a single narrow corridor, even the hint of confrontation adds uncertainty, and uncertainty has a cost. CNBC reported that energy stocks jumped while broader indices fluctuated. Defense contractors saw early gains. Investors were reading the situation clearly. Prolonged tension in the Gulf means higher energy volatility and expanded security operations. But what does that mean for everyday Americans? The U.S. Energy Information Administration has repeatedly warned that global supply shocks, even temporary ones, can translate into domestic price pressure. The United States produces a significant amount of its own oil, yes, but it does not operate in isolation. Oil is traded globally. When Brent crude rises overseas, it pulls benchmarks upward everywhere. The New York Post highlighted how gasoline prices had already begun edging higher in certain states following the latest developments. Analysts cautioned that if disruption fears persist, drivers could see further increases in the weeks ahead, and that is the multiplier effect of Hormuz. Insurance markets responded almost instantly. According to reporting from Financial Times, maritime insurers began reassessing war risk premiums for vessels operating near the Gulf. Premiums do not need to double to send a signal. Even modest increases shift cost structures for shipping firms. Those costs ripple outward. Freight becomes more expensive. Energy imports become more expensive. Inflation pressure builds. Meanwhile, the Wall Street Journal noted that major shipping firms were carefully evaluating transit schedules through high-risk zones. Tanker captains do not make political statements, but they respond to insurance advisories and threat assessments. If a vessel slows down, reroutes, or pauses, the supply chain feels it. This is not theoretical. In previous periods of tension in the Gulf, even temporary slowdowns have triggered short-term price spikes. Markets do not wait for catastrophe. They react to probability. And here is what makes this moment especially sensitive. Global energy markets were already tight. OPEC production decisions, post-pandemic recovery patterns, and geopolitical fragmentation have reduced the buffer that once existed. There is less slack in the system, so when Hormuz heats up, traders know the margin for error is thinner. From Washington's strategic perspective, ensuring uninterrupted navigation is not just about military posture. It is about economic stability. Every administration understands that domestic fuel prices influence political mood, consumer spending, and economic confidence. This is why responses to threats in the Strait often appear swift and decisive. Deterrence is not abstract. It is tied to the cost of living. At the same time, Iranian officials have framed developments as resistance against what they describe as external pressure. State-linked outlets such as Press TV emphasize sovereignty and regional balance. Yet the broader market response suggests that investors see heightened instability rather than equilibrium. When markets vote with capital, they reveal perception, and perception is powerful. If the belief takes hold that Hormuz could become unpredictable, capital reallocates. Supply chains adjust. Strategic petroleum reserves become part of the conversation. Policymakers start running contingency models. This is how a narrow waterway halfway around the world ends up influencing conversations at American kitchen tables. Because when oil moves, everything moves. The current escalation has not yet produced sustained supply collapse. Ships are still moving. Exports continue. But the psychological impact alone has reminded the world how fragile certain arteries of globalization truly are. The question now is whether this episode stabilizes quickly or whether markets begin to factor in a longer period of Gulf volatility. If it is the latter, the economic dimension of this confrontation may become just as consequential as the military one. To understand the current escalation, you cannot isolate the Strait of Hormuz from the broader Middle East landscape. This is not happening in a vacuum. The region is already layered with overlapping tensions. According to CNN, international diplomatic channels between Washington and Tehran have remained fragile for years, punctuated by sanctions, proxy confrontations, and periodic negotiations that rarely produce lasting breakthroughs. Add to that the ongoing shadow war between Israel and Iranian-backed groups across Syria and Lebanon, and you have a region operating under constant strategic pressure. Now place Hormuz inside that environment. The Jerusalem Post has repeatedly warned that Israel views Iranian military expansion in the region as a long-term existential concern. Iranian drone transfers, missile proliferation, and proxy coordination have shifted the regional balance over the past decade. For Israel, the concern is not limited to nuclear capability. It is about the encirclement effect created by aligned groups across multiple borders. Saudi Arabia and the United Arab Emirates see the situation through a different but equally urgent lens. Al Arabiya recently reported that Gulf officials are increasingly wary of being drawn into direct confrontation. Their economies depend on energy exports, foreign investment, and stability. Any perception of uncontrolled escalation threatens those pillars. The national based in Abu Dhabi has emphasized the delicate position Gulf states occupy. They maintain security ties with the United States, while also navigating economic relationships with global powers, including China. A prolonged conflict in the Gulf forces difficult choices. And then there is Oman. Historically, Oman has served as a quiet intermediary between Washington and Tehran. Several back-channel talks over the past decade were facilitated through Muscat. When tension spills near Omani waters, it complicates one of the few diplomatic pressure valves still functioning in the region. Meanwhile, Iran itself is operating under sustained economic strain. Sanctions remain heavy. Currency volatility persists. Domestic pressures fluctuate. Iranian state media often frame confrontations as resistance against external coercion, but international economic data paint a picture of constrained maneuverability. This does not mean Tehran lacks agency. Quite the opposite. Analysts cited by Reuters and Financial Times note that Iran's strategy often relies on calibrated escalation, pushing just far enough to assert presence without triggering full-scale war. But calibrated escalation becomes increasingly risky when multiple fronts are active. The broader Middle East is currently balancing several unstable dynamics. Ongoing friction between Israel and Iranian-aligned groups, maritime security concerns in the Red Sea and Gulf, energy market fragility, U.S. force posture adjustments across regional bases. Each of these alone would require careful management. Together, they create a strategic mosaic where small actions can produce disproportionate reactions. From Washington's vantage point, the objective remains clear: maintain deterrence without sliding into uncontrolled war. The presence of U.S. naval assets in the Gulf air bases across Allied territory and missile defense systems throughout the region signals readiness, but also restraint. Deterrence is about convincing the other side that escalation will cost more than it gains. Iran, on the other hand, seeks to demonstrate resilience. By operating near strategic choke points, it signals that pressure campaigns will not go unanswered. However, the regional response suggests limited appetite among Gulf states for prolonged confrontation. This is the tension point. No actor appears eager for full-scale war, yet no actor wants to appear weak. That balance between strength and restraint is what makes the current moment volatile. Because in an environment already saturated with distrust, miscalculation becomes the greatest risk. Hormuz is not just a shipping corridor. It is a pressure gauge, and right now, that gauge is rising. In modern conflicts, missiles move fast, but narratives move faster. Long before analysts finish reviewing satellite images, headlines have already formed impressions. Markets react. Public opinion hardens. Allies calculate. This is where the battle shifts from the sea to perception. Iranian state-linked outlets, such as IRNA and Press TV, have framed the latest developments as defensive resistance against foreign militarization of the Gulf. Official statements emphasize sovereignty deterrence and what Tehran describes as unjust pressure. The message is clear: Iran is not escalating. It is responding. At the same time, Western coverage presents a sharply different picture. Reuters has consistently focused on freedom of navigation and the protection of commercial shipping. AP News highlights the risk posed to civilian maritime traffic. Financial Times has underscored how even the threat of disruption destabilizes global energy markets. These differences are not trivial. They shape how audiences understand responsibility and risk. Consider the numbers. Iranian media have occasionally cited figures suggesting limited damage or minimal operational impact from U.S. responses. However, independent defense analysts quoted by Defense News and BBC security correspondents point to visible shifts in naval positioning, increased aerial surveillance, and precautionary force dispersal patterns consistent with heightened alert levels. This divergence reveals something important. Information is now part of the strategic toolkit. From Tehran's perspective, projecting resilience is essential. Economic pressure remains intense. Domestic audiences must see strength. Regional partners must see reliability. A narrative of vulnerability could invite further pressure. From Washington's standpoint, credibility is equally critical. If threats to a major maritime artery go unanswered, deterrence weakens not only in the Gulf, but globally. That is why official statements are carefully calibrated. They emphasize proportionality, legality, and protection of international norms. CNN's coverage has highlighted how U.S. officials frame their posture as defensive and stabilizing rather than expansionary. Meanwhile, the Wall Street Journal notes that maintaining coalition confidence is a central objective. So what is actually happening beneath the rhetoric? Satellite imagery analyzed by independent observers often becomes the tiebreaker in contested claims. Commercial imagery companies provide open-source verification that both journalists and governments use to corroborate movements at sea or on land. In previous regional flare-ups, discrepancies between official claims and open-source imagery have altered public perception within days. That is the environment we are operating in now. This is no longer a conflict where information can be tightly contained. Every maneuver leaves digital traces. Every claim can be cross-examined, and yet perception still matters enormously. If markets believe the Gulf is unstable, capital reacts even if ships continue moving. If regional allies believe escalation is controlled, confidence holds even amid military activity. Iran's messaging often emphasizes endurance, that pressure will not break strategic will. Western messaging emphasizes deterrence, that aggression carries cost. Both narratives serve strategic purposes. The key question is which narrative aligns more closely with observable behavior. Are commercial vessels rerouting? Are insurance premiums rising? Are regional governments issuing cautionary advisories? When these indicators move, they speak louder than press statements. Ultimately, information warfare is not about convincing everyone. It is about shaping enough perception to influence strategic calculation. Right now, perception appears fragile. The Middle East has entered another phase where messaging markets and military posture are tightly intertwined. The side that manages this triangle most effectively may gain advantage without firing another shot, and that may be the most consequential battlefield of all. So where does this leave us? The Strait of Hormuz is still open. Oil is still moving. War has not erupted, but something has changed. This latest escalation has tested lines that both sides have spent years carefully managing. It has forced regional actors to reveal priorities, and it has reminded the world how quickly strategic pressure points can become flashpoints. Let us look forward. From Iran's perspective, the path ahead is narrow. Tehran understands that a full closure of Hormuz would be economically devastating, not only for global markets, but for its own exports. Nearly all of Iran's maritime oil shipments depend on the same corridor it threatens. This creates a paradox. Hormuz is powerful leverage, but it is also self-binding. That is why many analysts at the Council on Foreign Relations argue that Iran's likely strategy remains calibrated disruption rather than outright blockade. Limited signaling, tactical pressure, avoiding a threshold that would invite overwhelming retaliation. But calibration becomes harder as tensions rise. Every drone launch, every missile test, every naval maneuver increases the probability of miscalculation. Rand Corporation assessments have repeatedly emphasized that escalation spirals often begin not from deliberate strategy, but from unintended interaction under stress. On the American side, the objective appears consistent: maintain escalation dominance without triggering regime collapse war. The presence of U.S. Naval Strike Group's layered missile defense systems across Allied territory and rapid air deployment capability provides overwhelming conventional superiority. Yet Washington's strategy is not purely military. Brookings Institution scholars note that deterrence works best when it is credible but restrained. Excessive force risks regional backlash. Insufficient response risks emboldening adversaries. The balance is delicate. Right now, that balance favors stability if managed carefully. Gulf states are not signaling appetite for prolonged confrontation. Energy exporters want predictability. Investors want calm. Global markets want flow, not fire. Even China and India, major consumers of Gulf energy, have strong incentives to avoid sustained disruption. Quiet diplomatic pressure from global powers may intensify if volatility persists. So what are the realistic scenarios for the next 3 to 6 months? Scenario 1: controlled tension. Naval posturing continues. Occasional incidents occur. Markets fluctuate but stabilize. Diplomatic backchannels quietly reopen. This is the most probable outcome if both sides prioritize economic stability. Scenario 2: escalation spiral. A misinterpreted maneuver, a strike causing unexpected casualties, or an attack on critical infrastructure pushes retaliation beyond intended limits. Insurance premiums spike dramatically. Energy prices surge. Regional actors mobilize more openly. This scenario is less likely but not impossible. Scenario 3: strategic de-escalation. Under economic and diplomatic pressure, both sides scale back visible activity. Hormuz remains symbolically contested, but practically functional. Messaging shifts from confrontation to deterrence restoration. Which path unfolds depends on discipline. The United States retains overwhelming naval and air superiority in open conflict. Iran retains geographic leverage and asymmetric capability. But neither side benefits from total war, and that is the stabilizing factor. The Middle East has entered another high-pressure cycle, but not necessarily an irreversible one. Hormuz remains open. Markets remain operational. Diplomatic channels, though strained, are not entirely closed. The next phase will not be defined by rhetoric alone. It will be defined by restraint, calculation, and the recognition that in a globalized economy, escalation has consequences that travel far beyond the battlefield. The Strait of Hormuz has tested the balance of power before. It is testing it again. The difference now is that the world is watching more closely than ever.